The final question of the paper again focused on analysis, so that was 2 in a row to finish with, along with question 11. And what you were given this time was the debt ratio from one year to the next went up, and the return on investment or ROI went up as well. And what you were asked to talk about was explain the relationship between the increase in the debt ratio and the increase in the return on owner's investment. Very tough question. So remember, like we said with question 11, know your ratios, know how they're calculated, know what they explain, and that includes asset turnover and all the efficiency ones, all the liquidity ones, and all the profitability ones. Just as importantly though, know what each ratio measures. So in this case, you've been asked about the debt ratio, which fundamentally measures stability, also liquidity, but it does have a little bit of profitability about it, and that's what we're going to try and explain with this question. That's in contrast to ROI, which just looks at profitability. So let's look at the debt ratio. So what's happened is it's calculated as total liabilities divided by total assets. So it's gone from 42% to 48%. What does that mean? It means that for every dollar of assets in the balance sheet, the business did have 42 cents of liabilities and 58 cents of owner's equity. So basically 42% of all its assets have been financed with debt. That's gone up to 48%, which means that liabilities now represent 48 cents of every dollar of assets, and owner's equity is only 52. We're a little bit worse off here. We're a little bit less stable, and that's because we've got a little bit more debt for every dollar of assets than we did the year before. So how could that get worse? And this is why you need to know how to calculate your ratios. So that number has gotten bigger. Mathematically, how could it get bigger? Well, there's two options. One, either the number on the top goes up, which is total liabilities, or the number on the bottom goes down, which is total assets. So looking at those two options, can we rule one in or out, or maybe we need to consider both? What we need to remember is that the question actually said total assets have remained unchanged. So what that means is total assets are the same. So that must mean I can only talk about option 1. I can't mention option 2 and say assets went down, because that didn't happen. The question said it clearly didn't. I'm going to get rid of that. But now I need to sort of talk about, well, how can I have liabilities go up but not have assets go up at the same time? For example, if I went and bought some stock on credit, I would not only have liabilities go up, which is what we need to happen. So what we're looking for is, can I get liabilities to go up but have assets stay the same? Now, if I buy stock on credit, yes, liabilities go up, but my problem is so do assets, and that's not going to work. And the reason why it's not going to work is we said assets, the question specifically said, did stay the same. Alright, what about if then we took out some money and I borrowed $5,000? Would that make liabilities go up? It would, so I'm okay here. That makes sense. However, would assets stay the same? They actually wouldn't, because now I've got more money. So assets would go up, and the problem with that is we said that can't happen. So it can't be that type of transaction either. Let's have a look at something a little bit different. What about if I sold an asset for cash? So whilst assets can stay the same, what about if I get rid of one? What about if I get rid of one asset? So we've got 1,000 there. Let's pretend it's 1,000 instead of 2,000. Sold a vehicle for 1,000. However, the problem there is assets will go back up because I get $1,000 of cash. Liabilities would stay the same, as would owner's equity. And the problem there is, yes, assets are the same. So that seems to meet my definition. We've said assets will go up and down by the same amount. The problem here is I need liabilities to go up. The debt ratio got worse, but assets stayed the same. So I need this number to increase, and it hasn't. So it can't be that either. What about if we took out drawings? You only took out drawings of $3,000. First of all, we've got less money. Cash has gone down. That decreases owner's equity. So liabilities has also go down. Now that kind of does make sense. Sort of. The problem here is that, yes, what would happen is my assets, my liabilities would be a bigger percentage of assets, but I need assets to stay the same, and they're not going to. They're actually going to decrease. So I've got a bit of a problem there. So overall, that option is not going to work either. But what am I going to write? How can I possibly explain how this happened? This is very, very complicated. So here's the best answer we've got. Why don't we sort of combine a couple of things together? Why don't we say take out drawings. Let's say you take out a car that's unproductive, it's $7,000, you get rid of it, you take it out for yourself. So we said we can't sell it because that won't work, because assets, liabilities won't increase. What about if we just take it out for ourselves? First of all, assets would go down, and so would owner's equity because it's drawings. Liabilities wouldn't go up though. So have I met my obligation here? Have assets stayed the same? They have not. Have liabilities gone up? They have not. So how can this answer be right? Well, what if after we got rid of that car, we went and bought another one, but we bought that new car on credit? So we went and bought it, so I got a new asset of 7,000, but this time I paid with a loan. So in this case, my liabilities have gone up. Nothing's happened to owner's equity. Does this meet the criteria? It does. Let's have a look why. Assets have gone up and down by the same amount, so they've stayed the same. Because I've gone and bought or rebought the car on credit or a loan, that's increased liabilities. That's what I'm going to have to talk about. It's a two-step process. Withdraw unproductive assets and then rebuy new ones with credit or debt. What about the ROI? What does that mean? Well, it's measured as net profit on average capital. So it's gone up. So what does it mean? When it was 21%, it meant for every dollar of owner's equity the business has, it was generating 21 cents in net profit. That's gone up in 2015. For every dollar of owner's equity, we're now getting 26 cents of net profit. So I'm a little bit better off. I'm a little more profitable. I'm earning more net profit for each dollar of capital in the business. So how can I make this better? Well, one option is to make the number on top go up, like so, and keep the number on the bottom the same. So is that a possibility? Well, let's look. What about if I made a net profit last year of 1,000 and that went up to 2,000? Well, by definition, a net profit is increased assets and owner's equity, so that's last year. And then what about if that's gone up from 1,000 to 2,000? Well, what I need to happen is I need for net profit to go up, and that's happened. But I also need for owner's equity or capital to stay the same. So that can't happen. If I make a bigger net profit, that would actually make my capital go up. So option one's not possible here. ROI couldn't have got better because I made a net profit or bigger net profit. Net profit must have been the same. So it must be option two. So what do we mean by option two? Well, clearly net profit must have stayed the same and capital must have gone down. How could we make that happen? Well, we keep net profit the same and we lower capital with either drawings or a net loss. That's the only two ways you can get drawings lower, drawings or a net loss. Now we can't have a net loss because we've got to have had a profit. So total assets are unchanged, and what that must mean is, let's try and summarize what we've learned. Debt ratio must have gotten worse. How? Two steps. One, took out drawings of it for ourselves, of assets, then rebought new ones on credit. Thirdly, we must have made ROI get better because we lowered the average capital, but we didn't do it through a net loss. We must have done it through drawings. So in terms of our answer, what could we write? Well, we only need 3 points, so I've got 4 here. Why don't we mention that the debt ratio means that the percentage of liabilities funding assets has increased, so the owner is contributing less capital. That must mean that ROI has increased because we've got the same net profit, but it's based on lower capital. So by definition, that will increase that ratio. How could we have done that? Well, we can't have made a bigger net profit or a net loss. It must have been because we took out drawings. And lastly, whilst assets are the same, they've remained unchanged, it must be because we've simply replaced old assets that we took out on drawings and we bought those new ones on credit, and that's basically made our debt ratio increase whilst keeping our net profit the same and increasing ROI. Looking at the marks, very difficult. I mean, a lot of kids just wouldn't have finished or got to this as the very last question. At the top end, only 8% of the state got 3, which isn't too bad really because it's a really difficult question. And given that it was last, that's not a disaster. In terms of the examiner's comments, a lot of students didn't complete it. And the main issue was linking the two indicators. When one happens, it sort of affected the other. And that's how you really got 3 out of 3 for this.